Well, investors are eagerly awaiting the latest read on inflation and what it will mean for the timing of rate cuts. CPI for the month of February is out Tuesday. The headline number year over year expected to remain unchanged from January. But core CPI, excluding volatile food and energy prices, is expected to soften a bit to 3.7%, slight decline from January's 3.9% reading. Here with more, we've got Citi Economist Veronica Clark. Veronica, great to see you here this morning. All right, so the expectations are laid out. What, though, will this mean for the pathway for the Fed here, and what data dependency and the trend that they're looking for in that data is actually signaling?
Yeah. The most important thing that we're watching at 8:30 tomorrow morning is the month-on-month change in core CPI. So the year-on-year rate should be falling, but we're actually expecting to see still some residual strength in that monthly number. We're expecting a 0.33% month-on-month increase in core CPI. Now that's following a very strong January. I don't think we'll see quite a repeat of what we saw in January, but still some stickiness to services inflation in particular. And that's not a great place for the Fed, but we kind of have seen Fed officials talking about maybe this is just some bumpiness on the path to 2% inflation, and they do still seem to want to be cutting rates as we're getting to the middle of the year. So I don't know if this February number will quite clearly change that quite enough. They still seem like they're going to be cutting.
Veronica, what's your base case for rate cuts now?
Yeah, we're expecting that we're going to see the first cut in June. I think that's relatively consensus at this point. We're penciling in 125 basis points total in cuts for this year. So that is cutting in June and then every meeting after June. And it does, we do have this stickiness to inflation still, but I think most importantly for our forecast, we are expecting that you could see some softer activity data as we're getting to the middle of the year. And that is probably what gets the Fed to be cutting every meeting.
So let's put this inflation data up against what we've been seeing on the employment situation front, because last week we got a reading that, at least on the headline of the non-farm payrolls, was better than expected. But then we got those key revisions. So what does that tell us really about where the employment situation, where the labor market sits right now from your perspective?
Yeah. We had a lot of January data, January employment data, January CPI that kind of looked like this reaccelerating economy, this too hot economy. And then this February employment numbers, they were a bit complicated. We did have a stronger than expected increase in jobs in February, but we did see those revisions lower. The unemployment rate still rising. So there are these signs that the labor market is starting to weaken and continuing to weaken. And we've definitely seen hiring slow down. We've seen that in the hiring rate in the JOLT survey. We've seen that in weekly continuing claims. It is taking people longer to find work if you do lose your job. We're not seeing the big outright layoffs yet, which is of course still positive, but that would really be the last step in a weakening labor market, and all those early steps are still there.
And Veronica, to go a little bit deeper on that, what do you think the labor market is going to look like around year end?
Yeah, we honestly are expecting a recession still, where we might be one of the last people still seeing those signs. But really this early weakening in the labor market, the slowdown in hiring, the pullback in hours worked, pullback in temporary help employment, all those early signals that the labor market, that labor demand is weakening, are still there. And those things can accelerate. You do have this non-linear element to a weakening labor market where the unemployment rate can rise relatively quickly. So we are still expecting to see that by mid-year, and we might be looking at a 5.5% unemployment rate by the end of the year.
What do you believe ultimately the Fed will kind of have on its plate in terms of the tone that it signals about the timing of its rate cut and the pacing of it as well?
Yeah, I don't think we'll learn necessarily too much more at the March meeting that we'll have next week. But as we're getting through the rest of this year, there probably will be more of this trade-off between high inflation, still some stickiness to inflation, and a weakening labor market. And I do think as we're seeing weaker activity data, weaker labor market data, they will probably be cutting every meeting. But at this point, they'll probably keep the same kind of implied cuts as we saw in December. We don't think there'll be much change in that March SEP next week.
All right, Veronica, always great to get your insight. Thanks so much for joining us here this morning. Veronica Clark, economist with Citi. Thanks.
Thank you.